Ever pondered how interest rates, inflation, and employment figures impact the stock market and your financial assets? Let's delve into the realm of finance and economics to decipher these associations. Envision it's the end of 2022, and JP Morgan depicts a potential doomsday scenario where the Federal Reserve might increase rates to 6.5%, a level not witnessed in over 2 decades. This could potentially trigger a severe worldwide recession. However, the on-stocks might not be as disastrous as one could think. The market's fall in 2022 might actually soften the blow of subsequent rate hikes. Jump to the end of 2023, and the scenario shifts significantly. The Dow Jones reaches a new historical high, spurred by remarks from San Francisco Fed President Mary Daly suggesting rate reductions in 2024. The potential for rate cuts appears to have sparked investor optimism, leading to stock market triumphs and bond yield drops. In February 2024, Fed Chair Jerome Powell
Look at the white shoes, look at the white shoes. Break it down, in your mouth. Watch your mouth, without it down. Suck it on down. Watch your mouth.
Verifies that the Federal Reserve's prediction for 3 interest rate cuts in 2023 stays the same. These cuts are predicted to decrease interest rates to 4.6% by 2024. The timing of these cuts, however, will rely on incoming figures and economic situations. Has the Fed recently begun to concentrate more on supporting a robust job market rather than combating inflation?
Ever pondered whether the Federal Reserve has recently shifted its focus from battling inflation to supporting a healthy job market? Let's delve into this fascinating topic. In recent years, market participants have been keeping a keen eye on the Federal Reserve, particularly in regard to the expected number of rate reductions. The anticipation surrounding the frequency of these cuts has been palpable, with everyone from investors to economists seeking further clues from U.S. job data and inflation reports. Indeed, the labor market data released by the Bureau of Labor Statistics has been a crucial indicator. In March, for instance, the market added over 300,000 non-farm payroll jobs, a number significantly higher than the expected 214,000. The unemployment rate also saw a decrease, dropping to 3.8% from 3.9%. The Federal Reserve needs help to balance 2 goals: keeping unemployment low and prices, inflation, stable. These goals usually work together, but sometimes one takes priority. Meanwhile, oil prices have been hovering at high levels due to escalating geopolitical risks. However, the likelihood of a substantial price jump hinges on the potentiality of Israel attacking Iran's energy facilities. In the coming days, attention will be focused on the Consumer Price Index inflation data for March. Federal Reserve officials will be scrutinizing these figures as they contemplate future interest rate cuts. Speeches by several Fed officials are also expected to provide valuable insight. Other key data to watch out for includes the Federal Open Market Committee meeting minutes and the Michigan Consumer Sentiment Survey results. The performance of global U.S. banks will also be under the microscope. Although a sequential improvement in March versus December results is anticipated, year-over-year comparisons are expected to be flat or lower. Looking at the stock market, stocks saw a rebound after encouraging jobs data, erasing much of the Thursday sell-off. However, the S&P 500 and Nasdaq 100 were still down for the week. The energy sector emerged as the best performer, while healthcare, consumer discretionary, and real estate sectors lagged behind. It's important to note that markets don't move in a straight line forever. However, trends can often continue for much longer than most people think. In conclusion, the Federal Reserve, under the leadership of Fed Chair Jerome Powell, has indicated that interest rate cuts are still likely this year despite a robust economy. However, if inflation continues to move sideways, there could be a reevaluation of the need for those rate cuts. So, has the Fed shifted its focus from fighting inflation to supporting a healthy job market? The answer, it seems, lies in the fine balance between maintaining a robust labor market and managing inflation.
In the banking sector, global U.S. banks are expected to see an improvement in March results compared to December. However, year-over-year comparisons are likely to be flat to lower. On the stock market front, stocks rebounded after encouraging jobs data, erasing much of the Thursday sell-off. However, the S&P 500 and Nasdaq 100 were still down for the week. The energy sector emerged as the best performer of the week, while healthcare, consumer discretionary, and real estate sectors lagged. In conclusion, interest rates, inflation, and labor reports play a significant role in determining the performance of the stock market. While interest rate hikes could lead to a recession, the impact on stocks might not be as severe due to market declines. On the other hand, rate cuts could boost the stock market, provided other economic data and conditions are favorable. Meanwhile, the labor market continues to show strength, and inflation data will be closely watched for its impact on future rate cuts.
Have you ever wondered how the Federal Reserve juggles its dual mandate of maximum employment and price stability? Like a tightrope walker, the Fed must maintain a delicate balance. But what happens when these goals clash? Let's dive into this conundrum. The Federal Reserve's dual mandate, established in the late 1970s, requires it to pursue maximum employment and price stability simultaneously. As you might imagine, these two tasks can sometimes conflict. Take the late 1970s and early 1980s, for example. During this time, the United States was grappling with high inflation. To counteract this, the Federal Reserve took the controversial step of raising interest rates. This action slowed the economy, taming inflation, but it also caused unemployment to rise. It was a classic Hobson's choice, a choice with no good option, but it was necessary to stabilize prices. Fast forward to 2023, and we find a similar situation. Once again, the Fed raised interest rates to combat inflation, potentially sacrificing some employment growth in the process. It's a delicate and often difficult balancing act, but it's vital for the health of the nation's economy. However, recent statements by Chair Powell,
I say Jerome, I say Jerome, digga, Rome's in the house. I say Jerome's in the house, watch your mouth.
suggest a possible shift in the Fed's focus. While still mindful of inflation, the Fed may be pivoting back to prioritizing full employment. This could mean that the Fed might cut rates if the labor market weakens significantly, even if inflation hasn't reached its target level yet. So what does all of this mean? Well, it means that the Federal Reserve's dual mandate is a complex and ever-shifting task. It's a constant balancing act, with the Fed constantly adjusting its approach to best serve the economy. It's a fascinating insight into the economic management of our nation. Let's delve deeper into the economic calendar for the week. Our attention begins on Monday with a by Neil Kashkari. On Tuesday, we have an array of events from the release of the NFIB Business Optimism Index, the 3-year note auction to keep an eye on. We'll be watching MBA mortgage applications, the CPI, Consumer Price Index, a speech by Michelle Bowman, wholesale inventories, the EIA Petroleum Status Report, Austin Goolsby's talk, the 10-year note auction, FOMC minutes, and the Treasury Statement. On Thursday, the focus shifts to jobless claims, the PPI, John Williams's discourse, the EIA Natural Gas Report, the Grain Market WASD Report, the 30-year bond auction, and Raphael Bostic's commentary. And finally, on Friday, we wrap up with import and export prices, consumer sentiment, another speech by Raphael Bostic, and Mary Daly's words. Concurrently, we are keeping a close watch on all Fed speakers this week: Kashkari, Bowman, Goolsby, Williams, Bostic, and Collins. Their insights are vital for predicting the future direction of monetary policy. In conclusion, Federal Reserve's dual mandate of maximum employment and price stability is a complex, delicate, and ever-evolving task. Demands hard decisions, careful balancing, and regular adjustment, all aimed at bolstering a stronger, healthier economy. Indeed, that's a motive we can all rally behind.